Fundamentals for the economy are likely not to recover right away, but later on in 2021, says Lyn Alden, founder of Lyn Alden Investment Strategy. Lyn, welcome back. It's a pleasure to get your outlook for 2021 today. Thank you for coming.
Thanks for having me back. Happy to be here.
Let's start with your outlook on the fundamentals first. And you were telling me offline that things will be shaky for a few months.
Yeah, so I mean, one of the most worrisome metrics out there is what's happening with the job market in the United States and elsewhere. And so, if you look at, I referred to since April something called the backward square root sign job recovery, which is that instead of having like a V-shaped recovery or a U-shaped recovery, you have a quick kind of V-shaped recovery at first. But then instead of getting all the way back up to its previous high, it starts to roll over and go sideways. And so if you picture that, it's like a backward square root sign, and that's unfortunately what we've seen. So we had the sharp rebound after the March and April kind of shutdown, but since this summer, it's really kind of rolled sideways. And unfortunately, the latest data point continued to confirm that. And now, with rising, hospitalizations and other metrics in multiple countries, a lot of countries are beginning to, institute kind of small scale shutdowns. In some cases, countrywide partial shutdowns, and so this winter ahead still looks pretty challenging, especially for small businesses and jobs.
Yeah, I think the last jobless claims number was higher than expected. Did that catch you off by surprise as well?
No, so this is, I mean, it's so far it's falling in line with my outlook. And also, if you look at just payrolls in general, we're still in the U.S. 10 million jobs away from previous highs. So we lost over 20 million jobs from peak to trough, and we got about half of those back. But now we're moving at a very slow rate, and so we added something like, out of memory, 245,000 jobs last month on net. And if you add 420,000 jobs, it would still take 2 years to get back to previous highs. And so we had that early sharp bounce back, but now it's moving very slowly.
Do you expect the jobs recovery rate to be mainly in the vein of temporary jobs or permanent workers?
A bit of both. I mean, we have the holiday season, but of course that's partially disrupted by the coronavirus, and we're seeing it kind of in different areas. So, government workers, local and state governments, they've been under pressure because a lot of states, I mean, unlike the federal government, they're not monetary sovereign, so they can't print money and keep their obligations. And so we've seen kind of a reduction in some of these more financially stressed local governments, whereas we've seen some strength in other areas. And so,
Yeah.
it's really kind of impacting the small business.
If I remember correctly, last time we spoke, you're of the view that policies really should stay away from stimulating job growth, and that we should let the private sector sort this out on its own long term. Do you see any challenges to having a natural recovery, given that COVID cases are still very high and actually growing as we speak?
Yeah, well, I think there's certainly a room for fiscal stimulus, and that can take multiple forms. That can
Yeah.
take the form of payroll tax cuts to make it easier to hire workers and to give workers more of their paycheck back. So I think there's a variety of metrics and kind of procedures they can do. But instead of kind of focus on getting those numbers up in the near term artificially, they basically can do a ton of things to make it more attractive to hire people and to give people bigger chunks of their paycheck back.
So I'm assuming, given your outlook, that you anticipate the jobs market to recover faster in the second half of the year?
I think there's a good chance for that. I mean, the next several months are, like I said, pretty challenging. I think you could see somewhat of an acceleration in the second half of next year because, we have another summer coming. People getting more and more exhausted from the shutdowns, from the lack of travel. And we'll see how some of these vaccines work, at least as far as changing, behavior. And so by the second half of next year, it looks more favorable. I still think it's going to take quite a while, though, to get back to previous all-time highs for jobs. I mean, in the previous two recessions, it always took several years to do that.
Okay. Do you think consumer sentiment closely follows job growth?
Yes, in insignificant part. No, that can be temporarily kind of decoupled because, for example, earlier this year there was a lot of job loss, but there are also big stimulus checks, and so people at first, in many cases, made more money by not working, and so it's easier to keep confidence up there. And we still see that, for example, if we look at some metrics like like retail sales, they're actually up. So,
Yeah.
whereas jobs haven't recovered, retail sales have more than recovered. And that's partially because, there's a lot of income replacement still available.
Yeah.
And so, I do think that over the long run, it's kind of the combination of jobs and any sort of stimulus that replaces some of that income.
I heard one argument from an analyst I've spoken to, and the argument is that retail sales are likely to decline next year as people have more money to spend on vacations and other bigger ticket purchases. That's going to eat away from some of the smaller item retail sales. Do you agree with that view?
I think it's a reasonable view. I think it's somewhat speculative, but I think the logic of that does make sense. We've seen kind of unusually strong retail sales this year, and you can argue that in part that people they're because they're able to save more money elsewhere, they're able to spend more on retail sales, and it's certainly possible that that could spill over into travel and other things next year. I think that's logical.
Yeah, I think one thing that surprised me personally was the very fast recovery of retail sales. If you look at the St. Louis Fed data, the retail sales have actually rebounded to above pre-COVID levels already. Was most of that from tech companies selling things online? It must have been, right?
A big chunk of that was e-commerce, yeah, especially earlier in the year. But then just broadly, I mean, people wanted to get back out. But yeah, we've already been seeing over several years that e-commerce was taking market share from physical retail, and that just accelerated by like a stepwise increase here in 2020.
Yeah, I think proponents of the tech sector will use that argument to say that, well, this is still a good time to be long tech. Would you agree with that?
I think you have to be selective because they're very highly valued, and so it's a rather crowded trade at this point. And with rates that have been kind of steady or moving upward, that puts some pressure on some of those really high valued equities. So I think there are certainly some that are better than others,
Mhm.
but I'd be careful about buying a broad basket of tech if I had, say, a multi-year view. I mean, as a trading thing, of course, you can follow the charts and people can come to their own conclusions about their own time frame.
Perfect. Let's tie this back into the markets now. What are the implications for the markets given your outlook on jobs, consumer sentiment, and the economic recovery?
It'll partially depend on fiscal stimulus because, like we point out before, that can decouple people's incomes from people's jobs, and it can kind of make those two things diverge. And so we'll partially see what happens with fiscal spending in Congress. But right now, if you look at equity markets, they become quite stretched. If you look at put to call ratios or other signs of euphoria, there's really a ton of bullishness in the markets, and we've seen somewhat of a rotation from growth to value. But and I'm bullish on a lot of those value names long term, but they have come pretty far pretty quick. So I wouldn't be surprised to see some bumpiness in the months ahead. But of course, sentiment can always push things further than you think would be rational.
Okay. The stimulus that you mentioned, is that not already priced in? I think is the consensus already that we're going to get stimulus of around $1 trillion, or is that more or less still an uncertainty?
So when you look at the markets, there's always infinite things priced in, and I think part of the art is kind of teasing out what is or is not priced in.
Hmm.
I would say that based on the latest euphoria, I do think the market is assuming basically that fiscal stimulus is going to happen at some point or another, and that there's not going to be kind of a widespread insolvency issue that would likely happen if there were kind of a complete shutdown in fiscal stimulus at this point.
I'm guessing based on what you said which is that you're not very bullish on the equities for the next 6 months or so. Am I correct to say that?
Not as a base case. I still have a lot of equity exposure, but that's because I have a lot of individual stock selection, and I don't like to incur a lot of short-term capital gains by trading them too much. So it's more about setting expectations rather than something I'm trading heavily around. But I do think we have come pretty far pretty fast over this past 4 to 6 weeks.
How would you be positioning your equities portfolio just for equities?
So I've been somewhat bullish on healthcare recently because we've had a little bit of a lag there, and the regulatory environment is somewhat de-risked here in the United States, and so I'm finding some value in the healthcare space because they're fairly defensive, and I'm also finding a lot of value in international markets, so emerging markets, to some extent in Japanese European markets, more so than here in the United States.
Yeah, we're going to talk about the EM space in just a bit. At what point would you realize we're at a turning point for the better, or maybe for the worse? At what point would you say, okay, I've got to reweight my positions in equities because something substantially is changing, and that would affect my outlook?
I already have kind of the long-term equity position I'd like to have. So it's more about kind of seeing a pullback, and then I'd be willing to potentially lean into that pullback. And so especially in some of these value names, whereas I think some of the growth names are somewhat structurally overpriced at this point. I'd be cautious about buying dips. Whereas the sectors that performed really poorly earlier this year, like energy, for example, and that have recently rebounded on pullbacks, I'd be certainly happy to buy those and kind of layer into those.
Okay. What is your outlook on monetary policy and how that affects the fixed income market?
So currently, they're buying at roughly 120 billion a month in treasuries and mortgage-backed securities, and so we'll see what happens in the next couple of months. I don't expect major changes to that. Now, if bond yields rise above a certain point, I think that starts to get more interesting. We could potentially see renewed discussions of yield curve control or increased bond purchases by the Fed.
Maybe they could start buying ETFs like the Bank of Japan? No.
Uh, Probably not because they'd most likely have to change the Federal Reserve Act. And so, I mean, they were able to use a special purpose vehicle to buy corporate bonds, which technically they should not have been able to, without that. But I think going straight into equities is probably outside of their current mandate.
But you don't see a potential surprise in terms of raising rates? Do you see nominal rates increasing in the next year?
No, I don't see the Fed increasing their federal funds rate. But of course, the long end of the Treasury curve can mostly do its own
Sure.
thing unless they decide to override it with yield curve control like they did back in the 1940s.
Sure. Okay. And that should the long end of the curve rise, would that weigh down on equities valuations, you think?
I think it certainly could, especially on the growthier side, and so that can be beneficial for financials, more
Yeah.
companies in kind of the value space, especially because often associated with increasing inflation expectations, which could also benefit some of the commodity plays and other things that are more on the value side of the thing. But in terms of these kind of growth stocks are kind of priced like long duration bonds, right? You're pricing out all that growth in the future, and so it's really kind of dependent on using a very low discount rate, and so those are somewhat sensitive to rising rates.
Yeah, yeah. Do you prefer growth over value right now? Is that if you were to classify your investments into either of those categories, what would you prefer?
With a multi-year view, I prefer value over growth at this point, but I'm very selective in terms of individual companies, and so I don't particularly like buying like a broad basket of value or growth. I like going into individual companies, but I have been finding more opportunities in the value side of that, especially international value.
Can you share with us one name that you like?
For example, I've been bullish on some of the banks lately.
Okay.
That includes Scotiabank, that includes Sberbank of Russia, that includes some of the Singaporean banks. I'm pretty bullish on some of those higher quality, larger banks. With like a 3-year view.
Okay. And that's mainly due to low interest rates, or is that for
Well,
another reason?
it's partially recovery, and
Okay.
so they were killed earlier this year. They got to very low valuations. We've seen an increase in the yield curve for some of these countries, and so as the market gets a better handle on what the credit losses were, some of those are they were rather cheap compared to what the reality ended up being, largely due to all the stimulus that basically kind of prevented insolvency, in exchange for weakening currencies.
Okay, let's talk about gold's drivers for 2021. I showed you this chart offline. I'll pull it up again. The GLD versus the TIP ETF. Now, if you looked at the historical correlation between these two variables over the last 5 years, it's been pretty strong. Recently, in the last couple of trading sessions, a couple of weeks actually, it's diverged with the TIP ETF trending upwards and the GLD. Well, as you know, gold has been down, slight recovery, but still down. So I wonder if you think this divergence is of any significance, and what could possibly cause divergence between gold and inflation expectations.
Yeah, something to keep watching. And so, that's a pretty good metric is comparing gold to inflation expectations. I like to go a little bit further by comparing gold to real rates, which is nominal yields minus inflation expectations. And so part of it is that we've seen a pretty sharp increase over the past several months in real yields. And that's because the 10-year Treasury, for example, it bottomed back in August, and it's been on a pretty significant increase since then. So even though we've seen kind of a mild increase in inflation expectations, we've seen an even sharper rise in nominal yields. Now, they're still very low. So, for example, back in August, real yields by that metric reached something like negative 1.08%, and they've only rebounded part of the way. So they're still very much negative, and they're still very low, and that's still very favorable for gold. But gold came very far, very fast. So we've seen this correction. Now, the interesting thing is that ever since roughly November 9th, roughly mid-November, we have seen an easing in real rates, and so it's kind of trended sideways to down, and yet gold still got dumped a little bit. And there were a couple kind of theories about that. It could have been that the Bitcoin rally took some of its thunder, but so I focus on kind of multi-month outcomes for gold, and so it tends to follow real rates over any multi-month period, and it can certainly diverge in terms of weeks, especially because you know like I said, the value stocks came pretty far pretty fast. So a lot of people might have rotated from gold into energy, or gold into copper, gold into uranium. And so, I think that there's been a lot of other exciting things that investors could have gone into. And so I'm not surprised to see somewhat of a divergence. I would be surprised if that divergence were to continue for several months.
Gold and the dollar. So another interesting variable to look at. The dollar and gold have traditionally held an inverse correlation in certain times of its history, or their history. For example, the last 3 months they've been trending together downwards. Can you explain that phenomenon?
So it partially depends on what their underlying reasons are. And so, over the past, couple years, we've seen somewhat more of a correlation, and that's because it's been associated with risk off. And so whenever there's kind of solvency events or liquidity problems, investors have pulled into both gold and the dollar. So we've had somewhat of a positive correlation. Over the long term, if we were to see the dollar weaken versus a basket of major currencies and gold hold up well in those currencies, then by extension, you would see a higher price, in dollar terms for gold. And so you should see that inverse correlation come back if we were to get another major down leg in the dollar. But lately, some of these fluctuations have been pretty small, and so it's not something that I consider as important as what's happening with real rates.
Okay. The EM space, emerging markets. I know you've looked at that. Can you just give us a few of your preferred jurisdictions for 2021?
Sure. So most of this year I was really bullish on Chinese tech, and but they came pretty far pretty fast. We've also seen some increased regulatory action against them. I still remain bullish on them long term, but I'm increasingly interested in diversifying a little bit. So I've been bullish on India, Russia, even Latin America to some extent. I was more cautious on them earlier in the year. But we're seeing, some signs of life out of there, especially, because a lot of industrial commodities and agricultural commodities have done pretty well. And so I'm pretty bullish on a rather broad set of emerging markets.
One of the questions I get asked often by people that I know is, how do I invest in EM? How do I enter the space? What kind of investment vehicles would I be using?
So there are a couple. There are broad ETFs that can do it. One of the problems with those is that they're heavily weighted towards China,
Okay.
because they're market cap weighted, and China is a very big equity market, and so they tend to be heavily Chinese focused. And so for investors that want further diversification, you could, for example, buy a broad ETF, but then also there are some ex-China ETFs. And so you can have kind of a 50-50 split, and that would reduce your overall China weighting. You can also use regional or single country ETFs. So for example, you can buy an India only ETF, or you can buy a Latin America ETF. And for me, I also like to go into some individual companies in those space. So I use a blend of individual companies, as well as some of these regional ETFs and single country ETFs.